We humans are just kind of wired to when we see a lower price tag, it just becomes more attractive to us.
So why do companies do this? Welcome to the No Bull Guide. Today we're going over what is a stock split. A stock split happens when a company increases its number of outstanding shares to boost the stock's liquidity. It is exactly how it sounds. A company takes its available shares and splits them into 1, 2, or 3, and the number of shares you own increases, but the price of the stock decreases, so the total value of your investment actually stays the same. A stock split is a way for companies to change the per share price without changing market cap. So why do companies do this? Public companies implement a stock split after the share price has exhibited some significant growth, and reducing the trading price into a more comfortable range will make their stock look a bit more attractive from a per share price and encourage investors to buy it. But why don't some companies do this?
Yes, Nicole. Some companies don't do stock splits because there has been studies shown that stock splits tend to attract, retail investors, and investors are looking for smaller amounts when it comes to their stock purchases. So some management doesn't want that. Even though we have fractional ownership, some people miss out on that. But management also likes to sometimes have a higher stock price because it could tend to act as a barrier for entry for retail investors and day traders who look for that volatility at some point. So what are some common misconceptions about stock split? We've talked about this before, but unit bias is very much the thing. Investors looking to own one or a whole of something rather than using the fractional ownership that they could do on some platforms like our presenting sponsor, eToro. And there's also that misconception that stock splits economically change the value of the company, which we know is not true. Zaid, what are some ways that the investors could be hurt or helped potentially by stock splits?
Yeah, so the NASDAQ did a research and they said that just by announcing a stock split, the company's stock increases on average by 2.5% just by announcing it. And also, if you track that, the average stock of a company that announces a stock split will outperform the market by 5% within 1 year. So as an investor, if you own a company that announces a stock split, there's a chance that, based on this research, that you might see good performance from your stock. The downside is a lot of people might not understand that a stock split doesn't increase the price or the value of a company just because the stock price itself changes. So just do your research to understand that you're not changing the value of the company, you're just increasing the number of shares. But besides that, generally there seems to be positive outlooks when it comes to being an investor in a company that owns a company that is announcing a stock split. Stock splits are like a psychological play, right? We humans are just kind of wired to when we see a lower price tag, it just becomes more attractive to us. So when people see a lower price tag for a stock, they are more likely to buy it, even though, again, like I mentioned, the value of that company doesn't change, the underlying market cap of the company doesn't change, but we're just more likely to buy that stock.
Hey guys, thanks so much for tuning in. Be sure to like, comment, and subscribe, and hit that notification bell. We'll see you tomorrow.